You called the direction right. Price went exactly where you said it would, and you still lost money on that trade. Direction is the easiest thing in trading to be right about, and the least valuable. What separates the trader who gets paid from the trader who gets stopped is never the signal itself. It is where that signal happened. The same change of character, the same liquidity sweep, the same fair value gap can be a professional entry at one price and a trap 50 pips higher. Same pattern, opposite outcome, and the only thing that changed was location. So in this video, you will learn one of the best liquidity trading strategies, combining market structure, change of character, liquidity sweeps, fair value gaps, and premium and discount zones. This is a complete smart money framework based on supply and demand, designed to help you understand how to read liquidity in forex and identify high probability trading opportunities with precision and consistency. So, if this kind of content helps you, take a second to like the video, subscribe, and turn on notifications so the next lessons reach you the moment they go live. And feel free to share in the comments which topics you would like us to explore in future videos. And if you want to support the channel on a deeper level, consider becoming a member to unlock exclusive content and help keep these lessons coming. You'll also find links to our trusted partners in the description below. Using them costs you nothing, and it directly helps the channel keep producing free educational content like this. To judge where a signal happens, you first need a map. That map starts with ideal trends and potential reversals. In a well-defined uptrend, price consistently forms higher highs and higher lows, showing clear directional strength. Each time price pushes above a previous high and establishes a new structural point, it reinforces the idea of trend continuation. At that moment, we identify the lowest point that initiated this upward move and label it as the protected low. While price remains above this protected level, market control stays firmly in the hands of buyers, meaning our focus should remain on long opportunities only. As the market continues to advance and forms another new structure, this bullish bias remains valid as long as price respects the newly established protected low. This level plays a critical role because any return to it often attracts buyers who are willing to defend their positions and maintain upward momentum. Notice what the protected low really is. It is the price where every trader who is already long stops feeling comfortable. Loss aversion does the rest. People defend a position far more aggressively than they open one, so that level attracts real orders. Now, consider a different scenario, where price is unable to create a new high and instead breaks below a previous swing low. This behavior signals that buyers are losing control, while increased selling pressure begins to dominate the market. This transition is commonly referred to as a change of character, and it often serves as an early indication that a potential reversal could be developing. In other words, it reflects a weakening trend and opens the possibility for movement in the opposite direction. And here is where most traders start losing money while being technically correct. Spotting a change of character feels like seeing the future first, and the brain rewards being early far more than being right. So the moment the level breaks, the trader stops asking where price is and starts asking how fast he can get in. That said, not all trending conditions are perfectly structured. In less ideal situations, price may produce what appears to be a valid change of character, only to continue moving higher afterward. This creates confusion for many traders, who interpret the signal as the end of the trend and prematurely enter short positions. When analyzing multiple market scenarios, it becomes clear that a change of character does not always indicate a true reversal, but can instead occur due to temporary structural shifts that we will now examine. Invalid change of character. The first case is failure to continue. When price breaks below a swing low, but lacks follow-through and quickly reverses back upward, the change of character becomes weak or invalid. This is especially true if price then moves higher and breaks above the previous high, confirming that the overall bullish trend remains intact. The second scenario is the liquidity grab. When a swing low is positioned within a known liquidity zone, Price can briefly dip below that level to trigger stop orders and collect liquidity before reversing sharply. This movement is not a genuine breakdown, but rather a deliberate attempt to access liquidity, which ultimately makes the change of character invalid. The third situation involves fair value gap mitigation. In cases where a fair value gap exists below the swing low, price may move downward to fiddle or partially mitigate that imbalance before continuing higher. Here, the downward move is simply a reaction to rebalance the market, not a true structural shift, which means the change of character should not be considered valid. Look at those three cases together, and you will see what they share. In all of them, the signal was real. Structure shifted and the pattern printed exactly as the textbook describes. What was wrong was the place. A low sitting on obvious liquidity, or right above an unfilled imbalance. There's also a bias working against you. After one reversal that actually paid, the mind starts seeing tops everywhere, because recent success feels like evidence. That is recency bias, and it is why a trader can filter these cases perfectly in a backtest and still take all three of them live. Under these conditions, we avoid treating the change of character as a confirmed reversal, or using it as a basis for short positions. Recognizing these invalid scenarios filters out misleading signals and keeps your trades aligned with the dominant market direction. Up to this point, we have covered ideal trends, imperfect structures, and false change of character signals. Now let us move forward and focus on real reversals. A genuine reversal is not defined by a single break in structure, but by a sequence of events that reflects a clear shift in market behavior. It typically begins with price failing to establish a new high, indicating weakness, followed by a strong break below a protected low. At this stage, control transitions from buyers to sellers. However, the most reliable reversals do not occur randomly. Rather than appearing randomly, these reversals tend to develop around key areas, such as higher timeframe levels, or after an extended move where momentum becomes exhausted. Another important sign of a true reversal is a clear shift in momentum. For instance, the previous upward move may have created a fair value gap, reflecting strong buying pressure, but then momentum suddenly changes. Sellers begin to step in aggressively, and price forms a bearish gap. This sudden transition clearly indicates that control is shifting away from buyers and into the hands of sellers, increasing the probability of a sustained reversal. So treat a break of structure as evidence, never as a verdict. A valid reversal gives you three confirmations: the location where it happens, the liquidity it takes out, and the momentum that flips right after. One of the three is a story. 3 of 3 is a trade. Which brings us to the missing piece, because 2 of those 3 confirmations depend on knowing where price sits inside its own range. So, traders, what is premium and discount in the ICT methodology? And why does it matter when analyzing price inside a range? Within the ICT framework, price is not equally attractive at every level of the market. The location of price inside the range matters, especially when looking for higher probability entries and better risk-to-reward opportunities. That is where the concepts of premium and discount become important. But before we understand these zones correctly, we first need to understand what a trading range actually is. A trading range is simply the space between a swing low and a swing high in a bullish scenario, or between a swing high and a swing low in a bearish scenario. These swing points define the boundaries within which price is currently moving. Now, let us begin with a bullish example and understand how the trading range is drawn on the chart. In a bullish scenario, the trading range should be drawn using the Fibonacci retracement tool, with the 0 level placed at the swing high and the 1 level placed at the swing low. This means the upper boundary of the range is defined by the swing high, while the lower boundary is defined by the swing low. Once the range is established, the area above the 50% level becomes the premium zone, while the area below the 50% level becomes the discount zone. These zones help traders evaluate where price is positioned within the current market structure. Once the trading range is established, if price moves higher and breaks above the previous swing high, this creates a break of structure, confirming bullish continuation. On the other hand, if price continues moving lower instead of breaking higher, the market may begin forming a change of character. So, the key idea is understanding the sequence inside the trading range. First, the range is established. Then, a retracement forms. From there, the market reaches a decision point. Once price breaks above the trading range, we begin identifying a higher low and a potential higher high as the bullish structure continues developing. This is why it is so important to learn how to mark the trading range in real time, instead of only studying static examples after the move is complete. As price evolves, the trading range must also be adjusted according to the developing market structure. However, within the ComLucro framework, the range only becomes fully fixed once price delivers a valid retracement, specifically reaching at least the 0.382 level, which is one of the criteria we use to define a valid pullback. At that point, the structure becomes more clearly established, allowing us to properly define the higher low and higher high on the chart. Until then, while price continues expanding upward, the trading range remains dynamic and adapts to the developing price action. Now, the same logic can also be applied in bearish market conditions. In a bearish scenario, the trading range is drawn from the swing high to the swing low using the Fibonacci retracement tool, with the 0 level placed at the swing low and the 1 level placed at the swing high. The area above the 50% level becomes the premium zone, while the area below becomes the discount zone. When looking for long trade opportunities, we generally want price to trade within the discount zone, assuming other factors support the setup. The deeper price moves into the discount area, the greater the potential risk to reward ratio becomes, especially when a stop loss is placed below the swing low and the target is positioned near the swing high. In bearish market conditions, traders typically look for short opportunities within the premium zone. The higher price trades into the premium area, the better the potential risk to reward ratio, especially when the stop loss is placed above the swing high and the target is positioned near the swing low. Now you have the map and the ruler. This brings us into the second part of the video, where we turn them into a structured reversal trading strategy. This approach combines multiple smart money concepts and operates using two different timeframes. On the higher timeframe, our objective is to determine the overall market direction and identify key supply and demand zones where price is more likely to react and present trading opportunities. At the same time, we must consider where price is positioned within the range. If we are looking for short trades, our focus should be on premium zones, where price is relatively higher within the range. On the other hand, if we are looking for long trades, we want price to be trading in discount zones, where price is relatively lower and offers better risk-to-reward opportunities. Once price approaches and enters one of these predefined zones, we shift our attention to a lower time frame. At that point, we patiently wait for a clear reversal setup to form before entering the trade, always aligning our position with the direction identified on the higher time frame. While this strategy is flexible and can be applied using various time frame combinations, a good rule is to ensure that your entry time frame is at least 2 times lower than your higher time frame. That sequence is the whole thesis. The zone comes first, the signal comes second, and a signal outside the zone is a different trade entirely. Another important advantage of this approach is its versatility across different markets. Whether you are trading forex, crypto, stocks, or futures, the same principles can be applied effectively. Even so, any strategy should be thoroughly back-tested before you risk real capital. Paper trading and reviewing past data show you how the strategy behaves, and that is what builds confidence and consistency in your execution. Now, let me walk you through how this strategy plays out on a price chart. As mentioned earlier, the method relies on analyzing 2 time frames. We begin with the higher time frame, where we study market structure to determine direction and highlight key supply and demand zones. If the market structure is unclear or lacks a defined trend, it is always better to step away and look for another instrument instead of forcing a setup. To properly define direction, focus on how price forms swing highs and swing lows, as these elements clearly reveal the underlying trend. When marking key supply and demand zones, Look for areas that created a clear imbalance, or identify candles followed by 3 strong momentum candles. In the example shown here, we can clearly identify a key supply zone. As price returns to this level, we anticipate a rejection toward the downside, which may provide a high probability trading opportunity. At this stage, it is also important to consider where price is positioned within the range. For short trades, we ideally want price to be trading in premium areas, where it offers better risk-to-reward opportunities. The first step is to wait patiently for price to enter the zone. After that, we move down to a lower time frame to refine our entry for a short position. Avoid entering too early, before price fully returns into your zone, because the market often targets early entries. This behavior can lead to situations where price eventually moves in your expected direction, but only after first triggering your stop loss. That is the most expensive way to be right, and it comes from a simple place. Waiting is boring, and boredom feels like doing nothing. Sitting on your hands while price travels toward your zone is the highest paid work you do. Now let us shift to the lower time frame for a closer look. On this lower time frame, price is currently forming a short-term uptrend. In this context, our goal is to identify a reversal signal and take a short position against this local trend. That is exactly why this method is referred to as a reversal setup. Even though we are taking trades against the lower time frame trend, it is important to remember that we are still aligned with the higher time frame direction. This alignment becomes even stronger when our entries are positioned in the correct areas of the range, meaning premium for short trades and discount for long trades. At this stage, I want to introduce 2 powerful entry techniques that you can use to execute your trades. The first entry type combines a change of character with a liquidity sweep. A strong setup appears when price first sweeps liquidity above a previous high, and is then followed by a clear change of character. This liquidity grab indicates that buy-side liquidity has been taken, trapping early buyers in the process. The confirmation of the reversal comes from the change of character, where price breaks the most recent structure and shifts the market direction to the downside. It is important to note that all of this price action is occurring within a higher time frame supply zone. Think about who is on the other side of that entry. The trader buying that break is not being irrational. He is doing what he was taught, buying strength as price makes a new high. What he cannot see is that his order is the reason the move existed. The sweep went to that high because that is where the stops were parked. So rather than trading randomly on the lower time frame, we are executing within a well-defined context. After this sequence, we can wait for a pullback into a newly formed supply area or a fair value gap to refine and enter our short position. The second entry type is based on an inversion fair value gap. When an inversion fair value gap forms after price reaches a supply zone, it signals a strong shift in momentum. This setup is a powerful indication of a potential reversal and often leads to the highest quality trading opportunities. In this case, we place a sell limit order at the beginning of the zone and position our stop loss just above it. For profit targets, you can aim for a solid risk-to-reward ratio, such as 1:2 or 1:3, and then project the next target toward a key level ahead of the current price. An alternative method is to trail your profits, which can sometimes result in significantly larger risk-to-reward outcomes. The concept of trailing profits works in a simple and structured way. After entering the trade and seeing price move in your favor, you adjust your stop loss to just below the most recent swing low. As price continues to move, you keep shifting your stop loss below each new higher low. Managed this way, if price reverses into your stop loss, you protect the position instead of giving back profits. It also reduces emotional pressure and lets you stay in the trade for as long as the trend remains active. Continue applying this method consistently, but always define a final target for your trade as part of your plan. If price continues moving in your favor, this can lead to substantial gains while maintaining controlled risk. Now let us move on and analyze some practical examples directly on the price chart. To fully understand how to apply this strategy, we will look at pound dollar on the 15-minute time frame. Next, we will mark the fair value gap, break of structure, and change of character on the chart. From this view, we can clearly observe that price is forming higher highs and higher lows, supported by strong upward breakouts. This confirms a bullish market structure, meaning our focus should remain strictly on identifying buying opportunities. The most recent impulsive move has formed large fair value gaps, clearly indicating strong buying momentum in the market. We identify the candle responsible for creating these imbalances and mark it as our demand zone. If price retraces back into this area, we anticipate a potential rejection to the upside, along with a possible trading opportunity. The first step is to patiently wait for price to enter our predefined zone and then shift to the 1-minute chart to execute the trade with precision. Looking at the 1-minute chart, we can observe a clear short-term downtrend, which represents a pullback into the higher time frame demand zone. At this stage, our objective is to identify reversal signals and signs of rejection from this area in order to open a long position. Ideally, we want price to be trading in a discount zone, where long opportunities offer the best risk to reward. However, if price breaks below the demand zone, we avoid taking any trade. As price continues to develop, we can spot a clear change of character. At the same time, an inversion fair value gap forms, along with a new bullish fair value gap. This combination represents exactly the type of reversal confirmation we are looking for. We can then position our entry at the beginning of the zone and place our stop loss just below it. For our target, we aim toward the higher time frame supply level located ahead of price. Always remember to follow a disciplined risk management plan and never risk more than you are comfortable losing, typically keeping each trade within 1 to 3% of your total capital. Notice that the exact same change of character that was invalid 3 times earlier in this video is now a valid entry. The candles did not change. The address did. Now let us shift to another example. Here we have the euro-dollar on the 1-hour chart. We begin by marking the break of structure, change of character, and fair value gap on the chart. From this perspective, we can clearly identify a downtrend. The candle that created the imbalance is marked as our supply zone, including its wick for full accuracy. In this bearish context, we want price to return to premium areas before considering short positions. From here, we wait for price to return to this area before moving to a lower time frame to look for confirmation of a short opportunity. Next, we move down to the 5-minute chart. On this lower time frame, price has already formed a change of character. We can also identify an overlapping area between an inversion fair value gap and a newly formed bearish fair value gap, creating a strong supply zone. This alignment provides a solid reason to initiate a short trade. As price progresses, it moves downward and forms another bearish gap. At this point, it is important to understand that not every fair value gap represents a valid trading opportunity. In this case, the second setup appears outside of the premium zone, which means it lacks proper alignment and does not validate it as a high probability trade. This is why premium and discount become essential. They tell you where the best opportunities are located and where trades should actually be taken. And patience does the rest. The first trade, aligned with structure and positioning, reaches its target, while the second trade is stopped out. This clearly shows that the goal is not to take more trades, but to wait for the right one and allow it the time to work. That second trade is the whole video in one chart. The pattern was correct, the direction was correct, and it printed right after a winner, which is exactly why it felt safer than it was. A win makes the next risk feel like it is being taken with the market's money. The only thing missing was location, and that alone turned an identical setup into a loss. It is also essential to avoid unrealistic expectations. Professional traders typically achieve returns in the range of 30 to 100% annually. Pursuing unrealistic profit targets often leads to a destructive cycle of constantly switching strategies after experiencing losses. This negative cycle occurs because expectations are not aligned with what any strategy can consistently deliver. And that cycle has the same root as everything else we covered today. Traders abandon strategies that work because they judge a setup by its shape instead of by its address. A change of character in a liquidity pocket, a gap taken outside the zone, those are not bad signals. They are good signals asked in the wrong place. So stop collecting patterns. Read location, liquidity, and momentum together, and the chart will tell you not only what might happen, but whether this is the price where it is worth finding out. So, trader, if this video brought you more clarity, like it, subscribe, and turn on notifications so the next lessons reach you. And tell me in the comments what you want me to cover next. And if you want to go deeper, you can become a member of the ComLucro Trader community right here on YouTube. It unlocks exclusive content, early access, and extra tools for your development, while directly supporting the channel. You'll also find our trusted partners linked in the description. Using those links costs you nothing and helps us keep producing this kind of educational content. And remember, the mission of the ComLucro channel is simple. We help traders build clarity, confidence, and structure, so every decision is made with discipline and intention. Here you'll find complete courses built as a true trading masterclass. Liquidity, market structure, higher time frame analysis, and supply and demand. Always focused on reading price and executing with a professional mindset. We also cover trading psychology, risk management, and long-term consistency. Because trading isn't just about charts. It's about mindset, discipline, and execution over time. Our main courses include smart money concepts, ICT, technical analysis, trading psychology, and Wyckoff. Alongside that, we share insights from respected traders whose work helps you understand how markets really behave. Thanks for watching, and I'll see you in the next video.